Good evening, everyone, and welcome to our today's podcast on roles of bonds in your investment journey. Today, I have Saurav with me. I am the co-founder of Jiraaf. Saurav is the co-founder of Jiraaf as well. Today we will be hosting this webinar for all of you. We have divided today's webinar into four sections. The first section will be an introduction to bond. The second is why bond is so powerful as an investment strategy. The third section is how Giraffe is enabling the investment in bond in India. And the fourth will follow it up with a Q&A session. So I'll just project the screen. So first we'll try and understand what is the investment landscape in India. So, most of us, once we start earning, the first thing that we do is, we start some SIP, we'll buy some mutual fund, then we'll graduate to buying some shares based on some friend's recommendation. As we move ahead in career and we start earning money, what we do is that we buy a real estate house for ourselves, and investment in gold is also done by the family. This is the typical investment journey, I would say, for most of the Indians. When we earn more money, we repeat the same cycle, that is buy shares. But if you see on the graph on the left hand side, fixed deposit savings, it give you somewhere between 15% sort of a CAGR, and obviously crypto, angel art, these are very exotic investments. But there is a huge gap, I would say, between 7 to 15, 17% kind of return, which can be achieved by investment in fixed income securities or bonds. So an investor needs a very, very balanced portfolio and should allocate a portion of their investable corpus in these asset classes. If you look at HNIs, ultra HNIs, and large family offices, they have very, very large allocation in this portfolio. If you are more mature investor, they'll have in fact 40-50% of their portfolio allocated in the fixed income space. Whereas a retail investor or even a mass affluent investor, they have a very, very low allocation to nil allocation in this asset class. However, this is changing with time, but before we go that, I'll just explain in a very, very simple term what is bond, what is fixed income. So bond is basically a promise to pay. Here, suppose a company or a government, they need money for various activities. Government will need money for various infrastructure activities. They will need money for various investment activities. Similarly, a company will need money for their growth capital, for their working capital needs. So what do these companies or government they do? They will issue a paper which is called as bond. This paper will capture the terms of the transaction, what is the interest payment, what is the periodicity, what is the underlying security. And these papers are then bought by investors. The investors can be retail investors, individual, it can be corporates, it can be mutual fund, it can be institution. They take these papers and give money against those papers to the particular company or government, whoever is issuing the bond. So in simple terms, bond is like a loan that an investor gives to a company or to the government, and against that they know what is the rate of interest, what is the tenor, and what is the underlying security that they will get against the money that they are investing. Now, as I mentioned, bond market in India is growing at a very, very rapid pace. You can see the graph on the right hand side. The total bond market in India has almost doubled in last 5 years, from almost 100 lakh crores to almost 200 lakh crores. It's almost two times it has grown. The graph on the right hand side below, you can see the size of the corporate bond market today. Again, is almost 22%. Obviously, the largest is the GSECs, which is the government securities. Now, this also has been growing over last decade or so. In around 2010 to 12, the corporate bond market size as an overall pie was less than 5%. The share of public issue and private issue, what do I mean by that? Is that the companies which are listed, which are public companies, or the bond which are listed versus the bond which are private. Okay, it's the private issuance of bond is almost the majority of the bond issuance that is being done in the market today.
Vineet, I wanted to pause you here.
As I was, yeah, yeah.
Yeah, I just want to ask you, is India's bond market different from the way the bond market behave in other countries? And if you can just throw some light on that.
So it's a good question. So in fact, globally, if you see most of the matured economy or, the top 20, 30 economies in the world, the size of the bond market in almost all the economies except India the bond market is much bigger than the equity market. In some cases, it is two times, three times the size of the respective equity market of that is point number one. Second, in most of almost 20% of individual portfolios are invested in bond. Vis-a-vis, we saw in the first graph almost 1 to 2% in case of India. So, which obviously it is changing in this graph, which is right now projected. We are seeing this how it has increased. From 20 in last 3 year itself, the retail participation in bond in it, right? The third point is that again in a matured, 80% of the bonds are, in fact, I would say A plus and below, and 20% of the bonds are, in the triple been issued historically are, I would say, triple A rated or double A rated bond, and you have very less issuance in the slightly lower rated bonds. However, the same thing has been changing over last, I would say, 5 years or so. So, just coming back to the slide, three, the retail participation in bond market in India has seen a tremendous growth and has grown almost 10 times. So now, as we saw, that the participation is growing, we understood what the bonds are, we understood how it is placed in the overall investment landscape. Let us see here why bonds are so powerful. Okay, so I'll just spend 2 minutes here. As you can see on the table on the top right hand top side, if you see a short-term fixed deposit, which most of the Indians tend to do, SBI fixed deposit for a 90-day will give you a 3.5%, or an HDFC would give you 4.5. Government of India is giving you almost 6.7%. In other words, you are getting almost 100% return more vis-a-vis an FD that you do with a top-rated bank. Now, another thing to be noted for all the investor here is that any FD that you do, it is sovereign guaranteed up to 5 lakh rupees. Okay. However, T-bill and GSEC is 100% guaranteed by Government of India. So suppose if you invest say 50 lakh rupees in T-bill vis-a-vis a 50 lakh rupees in FD, in case of an delinquency or a, default scenario, the government in case of an FD will give you 5 lakh rupees back. However, in case of a T-bill, you will get 100% of that money. Plus, you are getting almost 100% more return by investing in a more secured product. So now this again, this as an information, lot of HNIs, institutions, ultra HNS, they are aware of this and have been investing in these securities. And a lot of retail investors or mass affluent people, they are not aware of this and hence have been investing in fixed deposit. If you see the table below, say I'll just run you through HDFC Bank, which is a CRISIL AAA rated. If you put an FD for a 2 year tenor, you get a 7% return. However, you also have an HDFC Bank paper, which is the bond of HDFC, which you can buy, where you are getting 8.3% return. So now, again, as an investor, it is better to buy the bond of HDFC vis-a-vis putting money in as an FD, because you are getting almost 1.3% return, because you are taking exactly the same risk in both the scenarios. Now, the same thing plays out if you see the bonds of respective banks, be it Kotak, Axis, Shriram, Jana, Kars, etc. Now, from a security standpoint, obviously both FDs and bonds are secured, but FD is sovereign guaranteed up to 5 lakhs. The scope of diversification, again, diversification in case of FD is limited. However, in case of bond, you can diversify it across sector. Again, for an example, suppose if you have 10 lakh rupees that you want to invest, you, rather than putting entire 10 lakh in FD, you can buy bonds across the sector. You can buy a bond of HDFC Bank, you can buy a bond of Tata Group, you can buy a bond of Reliance. All of these are, extremely large companies, AAA rated companies, and you are getting better yield also, and you are diversifying from a risk point of view as well. From a liquidity, FD is not liquid, but yes, you can withdraw by incurring some penalty. In case of bond, they are less liquid. However, if it's a well-rated bond, there is still a secondary market available for that. So hence, bonds are very, very powerful again from an investment point of view. In this slide, we will see, we recently had our union budget for 2024. In this budget, a lot of changes were done from a taxation point of view. The taxation for listed securities, the short-term capital gain and long-term capital gain for listed papers were increased. What we believe that this reduces the tax arbitrage that equity paper had vis-a-vis investment in bond, and we feel that lot of capital reallocation will happen because of this, and more and more people and institution will now invest slightly more corpus in the bond space or the fixed income papers, and hence it has become more attractive.
Thank you, Vineet. That was very insightful. For me, I think the biggest learning was, how largely unaware the wider market is. For the longest time, I was also personally unaware of the different yields, especially, for example, a small finance bank bond versus a small finance bank NCD. There's a 3-4% delta, and there is so much of interest in a small finance bank FD today. But if you actually participate in a small finance bank bond, that delta can be 3-4% even now, right? So that was quite insightful for me. Going into why to invest in bonds, I think Vinny spoke about people are like the market is growing, why it is very powerful as a product and an asset class. But I will cover why is the investment so relevant to us as an individual. So there are 3 points. At the first point is investment in bonds is very good for steady and predictable return. This is one quality of bond which it cannot, any other asset class cannot match it. So we know equities. Yes, you can do mutual fund, you do a systemic withdrawal plan now, for similar purposes. But the kind of stability and predictability, both in terms of capital protection as well as in terms of cash flows, the kind of stability and predictability that a bond gives, you cannot match it with another asset class. So the first thing is how does steady and regular income help? So regular income helps for planning for regular expenses. What can these regular expenses be? So today I know my monthly household expenses, right? We have an electricity bill, we pay rent, we pay, let's say internet expenses, etc. So we know that there are these expenses which are recurring, and it is recurring every month. Then for everyone, of us who have loans, we have EMIs, and then obviously every month we pay our credit card bills, etc. Now all of these can be in a bucket of recurring, I would say, outgo of cash. And for this outflow of cash, we can actually make, rather than keeping aside money liquid, where that liquid capital will actually not fetch me any return, the more prudent or more efficient way of investment is that I make actually an investment which gives me monthly cash flows to meet these expenses. So that way I'm not keeping my money idle. My all of my money is completely invested. I am maximizing the potential of my money, and all my monthly cash flow need is actually met through making an investment rather than actually from savings, right? So this is, I think, a big powerful use case of bonds. And we can do it in very different flexible ways. So you can say that I will invest a larger corpus so that the interest income itself is used to pay out the expenses. Or we can look at it on a EMI to EMI basis, where it's okay, I will set aside 10 lakh rupees, let's say, at any point in time, and I know that the EMI from the fixed income investment is equal to my cash expenses that I have on a monthly basis, right? There is a lot of flexibility, and we can basically plan our finances that much better. The second thing in India which people don't do is goal-based investments, and that you can only do goal-based investments when there is predictability of, again, income, cash flow, etc. So again, here bonds become really powerful. You can actually use bonds to make investments for short-term and medium-term financial goals. What can be these goals? They can be like expense planning. I want to invest for an international vacation 1 year later. Again, rather than keeping or setting aside money to meet that expense, you can make an investment where I will, in a 1 year bond, where I will get that entire money back within the 1 year, right? So now you're actually made an investment, you have earned a incremental return, and you have also met your financial goal or your goal of making that international travel happen. Similarly, if I want to buy a car in 2 years, if I want to buy a house in 3 years, now these are all financial goals, and bonds are really powerful to make investments to meet these goals. Now, typically, we have, people have been using different products. You either create an FD to do this today. But again, in FD, the challenge with fixed deposit is that it does not even beat inflation. So while the FD actually you can make a 1 year FD, 2 year FD, 3 year FD, but on a post-tax basis, you will not beat inflation, and basically your actual worth of your money is going down, right? So by investing in bonds where you can earn, I would say higher than inflation on a post-tax basis, you're ensuring that your money is growing and also meeting your financial goals in the same time, right? So steady and predictable return is a very powerful use case of bonds. The next use case is diversification. So Vineet, if you can go to the next slide. Yeah. So the second reason for investing in bonds is for diversifying a portfolio. I think the most, I would say, basic concept of any portfolio is how well diversified that portfolio is, right? That is how we say that this portfolio is good or bad. A well diversified portfolio prevents you from any shock, right? So and that's why as the more you diversify, the better your portfolio becomes. Now, typically, we have been investing a large part of our portfolios in equities, and all Indians have been doing that because fixed income allocation is generally less. But here we wanted to showcase how allocating to fixed income improves your portfolio because it is very different. It behaves very differently from an equity asset class. So the first thing is on volatility. We know that in equity, it's a very volatile market, right? So any macro factor will impact, our portfolio or how each of the stocks move, on a day-to-day basis. So, for example, a US election is happening. For example, our union budget got announced. The election results in India got announced. A COVID hits, right? Any macro event that hits, your equity portfolio will be highly volatile. It will move up or down, and that basically restricts the way we can plan. And also it gives us, I would say, it will give us some sleepless nights, more often than not, right? But if you look at fixed income, it is completely non-market linked. That means anything that happens outside in the market does not affect my returns in a fixed income product. So by ensuring that I allocate some money to equity and some money to fixed income, it ensures that when there is some macro event, at least I know that my fixed income portfolio is not impacted at all, and that will give me better peace of mind. The second is investment horizon. As I said, we know that equity is very good for long-term, horizon. So if I want to invest for 10 years, equity market is great because, we can say that in 10 years it will appreciate. But if I want to invest for 1 year, can I say in the next 1 year the equity market will do well? I don't think any of us will be able to say that with a lot of confidence, or predict with a lot of confidence how the market will behave, right? So if I have a 1 year investment horizon, then fixed income becomes that much more powerful, right? 1 year, 2 year, 3 year, in these horizons, fixed income is very powerful because it's very predictable. So if I know that I have some use case for my money, I need my money for making some expense, I can't put that money in equity because I might lose my capital or part of my capital over there. But I know that in fixed income, this is a predictable return, right? And so I will get my principal back with this return over this period of time, right? So that investment horizon for short and medium term, again, fixed income is great. The third is in general returns. There is a certain, we believe that obviously equity markets give, because of the recency effect, I think last 3, 4 years, equity markets has done phenomenally well. But if we look at it from 2009, just after the financial crisis till today, or if you look at it from 1991, since our financial markets opened up, you will see that equity markets will give that return, in that 15 to 20% range. And in fixed income also, where you are able to take higher risk, you will be able to make those returns on a pre-tax basis. So pre-tax basis returns are comparable. Post-tax has a lot to do how you do your financial planning, tax planning, and also obviously now, as Vineet mentioned, the union budget has reduced the gap between equity and fixed income on a post-tax basis. Globally, diversification is the key portfolio strategy. That means that every investor, whether you like it or not, you should have exposure to all asset classes, and obviously the mainstream asset classes of equity and fixed income, so that your portfolio is that much more robust. So to build a robust portfolio, it is important to have exposure to both equity and fixed income. The third and most important, I would say, power of bond is also just earning those returns, right? So overall health of your financial portfolio can improve not only through diversification, but you can also ensure that your portfolio earns higher returns by spreading out this corpus well. So today we know that typically we think of our corpus in two buckets. One bucket is where I know I can't take any risk, and the other bucket is more from a growth where I can take some risk, and that is the bucket which will create long-term wealth. So in the risk-free corpus, typically we have our insurance expenses. We will, anything that we put as emergency liquidity. So we know that I at least want so much money which is liquid, which I can anyway anytime withdraw to meet any emergency expenses, etc. The second is third is we typically plan for, let's say, 1 year, 2 year, 3 year of expenses. So even if we lose our job, our salaries, we know that this is a corpus which is set aside, which will take care of my of my lifestyle for the next few years, right? For this corpus, you can set aside 20% of this of your overall corpus in this bucket. For this corpus, we'll typically invest in FDs, gold, and government securities, which are largely risk free, and gold is a real asset. Fixed deposits we just spoke about as lower risk, and obviously government securities, again, completely government guaranteed, right? So we invest our risk-free corpus in this. There is almost zero to very little chance of losing any capital in this bucket. The next bucket is growth corpus. Our growth corpus we use to build long-term wealth, right? And here, this corpus should also be split within, because this corpus we might need some capital in between to, as we discussed, to buy a house, buy a car, makes, for children's education. There can be so many long, like one-time big expenses, which will typically come out of your growth corpus. So this growth corpus also we split it into two buckets, which is less than 5 years and greater than 5 years. The greater than 5 year bucket, here you can invest in equities, buy real estate, and obviously larger 70% of your portfolio can be allocated here. Over a long period of time of more than 5 years, this will be very stable. But for the short to medium term bucket, which is less than 5 years, we should invest at least 30% of your portfolio here. And this can be split between corporate bond, SDIs. You can invest in different baskets of fixed income. The idea of this fixed income allocation is this money which you need within the next 5 years, you would ideally put, let's say, in FDs, but that FD is actually not beating inflation on post tax. So overall yield of your portfolio will go up if you invest this 30% in fixed income, which is a bit higher yield than FDs, which is typically corporate bonds. And the portfolio also becomes more robust by diversification. And third is overall, if you see in a 1 to 5 year period, given the market volatility or equity volatility, you will also have better peace of mind by investing this 30%. So by investing in this 30%, you earn higher return because otherwise you would have invested in FD. You have diversified your portfolio, and as well as ensure that you have better peace of mind. So again, these numbers will vary basis your personal risk appetite and personal financial situation. This was a very broad, generic guidance, that we have tried to give here, so that you basically understand how typically someone looks at a financial portfolio. Finally, we've all understood that investing in bonds is good, but before investing, one should always understand the risks. There are two key risks with investment in bonds. The first risk is a default risk, which is also called a credit risk, and the second risk is a liquidity risk. So, a default risk, what is a default risk? It occurs when the issuer, that means the company, or in a sovereign security, the government, basically the company or the government which is borrowing the money, is unable to repay that money, right, to you on the scheduled time. So if they are borrowed for 1 year, at the end of 1 year, they are unable to repay that money. This risk is a default risk. This risk will typically occur when the company will actually almost shut down, or go bankrupt. And why is this? Because when you're giving a bond, and especially when we do senior secured bonds, that means you have, the company's first liability is to you. So that means if the company has any ability to pay, the holder will be the first in line to receive that payment. First the bondholder gets, second, typically your operational creditors will get, and third, your equity shareholders will get that money, right? So typically any money that a company has to pay, the first, I would say, charge, which we call technically. So the first right is of the bondholder. So that means you will not, this risk occurs when the company has zero ability to repay, right? And this risk also sometimes goes into delays. So it might not be a default, but instead of getting your money in the scheduled time period, you might get it 6 months later, 1 year later, etc. Right? So this is what we understand as default risk. The second is liquidity risk. Today, India's bond market is maturing. So if you want to sell a bond in the secondary market, you find limited buyers today. This risk is called so liquidity risk. So that means once I've bought a bond or invested in a bond, I am forced to stay till I get my money back through repayments. I can't exit it in between by selling it in the secondary market because the secondary market is not so vibrant. So this is the second risk, which is liquidity risk. But for this, you can mitigate this risk by investing in more short-term opportunities, maybe 1 year, 15 months, 18 months. By investing in more short-term maturities, you know that your money is always a year or 15 months away at best, right? So you don't need to depend on the secondary market to get your money back, right? So these are the two key risks. As Giraffe, we are an online bond platform. We are a SEBI registered broker in the debt segment.
Just wanted to ask, can you give us some practical examples of how people are, using bond as an investment product for their various needs,
Right.
from, whatever experiences that you have, so that, it will give our listeners idea as to how they can as well, look at this from an
Yeah.
investment strategy perspective.
No, thank you for that question, Vineet. So I'll give one example. So, I know of a friend, he has dependent parents. So he earlier used to support his parent by sending them, 10,000 rupees a month, which was to meet their expenses, because they are not earning income anymore. So he realized after a period, of discussion, understanding bond as a product. So now instead of actually, sending 10,000 rupees, every month, he's actually invested 1 lakh in his parents name in a 1 year bond which amortizes over a 1 year period. So now the bond's name is in the name of his parents. They get a monthly cash flow from the returns of that bond investments which they use to meet their expense. So he's actually met two goals. Earlier he used to give it out of his salary or from his savings. He actually made an investment. Now that investment is not only earning a return but is also able to support the monthly expenses of his parents. This is example one, which is like, the regular cash flow we spoke about. The second example, which I can think of, a lot of people actually use bonds to actually earn very high returns, and we spoke about equities, but even in bonds, you can actually earn post-tax returns of 11, 12%. People are investing in the name of their wife, children, father, mother, who are not income earning. You can invest through an HUF, right, which is creating a vehicle to make an investment. So on a post-tax basis, you actually reduce the taxation from your marginal tax slab to a very low number, let's say a 5-10%, depending on the tax slab of that individual or the firm. And once you do that, basically you suddenly realize on a post-tax basis, you're actually earning 11, 12, 13%, which is then very, very attractive. Right. So overall, on a post-tax basis, you have increased the returns of your portfolio with a lot of stability, predictability, and rest everything we spoke about. Right. So these are two very practical examples that I have personally encountered, and as we spoke, there are multiple use cases of this.
Also, now from a timing perspective, what is your view? Uh, for someone who has not invested in bond, whether it is a
Hmm.
good time to invest, it is a bad time to invest. What are your views on that?
Yeah. So as a investor, or someone who's been in the investing space for now more than a decade, I've realized, and we all have realized, that timing the market for any product, is will never happen efficiently, right? So we may have our views in debt, in equity, in both. So first is every asset class should be a part of your portfolio. So sometimes returns in one asset class will go up or down, but they should always be a part of your portfolio. So if someone doesn't have bonds in their portfolio today, they should have it today itself. It doesn't matter, whether it's a good time or a bad time, and you should always have it as a part of your portfolio. That percentage might vary depending on your view, your financial situation, etc. So I think that is the first thing. The second is actually right now, coincidentally, is actually a great time to invest in bonds. Today, the interest rates in India are at its peak. We are all expecting RBI to reduce rates going forward, to boost the economy. And once that happens, overall yields starting from GSEC T-bill across all your corporate bonds also yields will drop when that happens. So today you can actually invest, in bonds at higher rates and lock in returns for the next 2 3 years. Vis-a-vis if you invest, let's say if you start your investment 1 year later, even though you might invest for 2 years, you will actually get a lower return. So today, by investing in and locking in your money for 2 3 years, you have actually ensured that your capital is earning a high return for that much time period. Obviously, if you find liquidity, etc., in the secondary market, by investing in a bond today or in a GSEC T-bill today, you can also earn some capital gains when the interest rate drops. But I think the most simple strategy is invest today, lock in your returns at a higher interest rate as the market is right now for the next couple of years. So it's a great time to invest in bonds in that sense.
Thanks, Saurabh.
So going further, just I'll quickly spend, I would say,
Uh,
5 minutes on what we do as
Over to you.
Jiraaf. As Jiraaf, as I mentioned, we are an online bond platform. We are a SEBI registered stockbroker in the debt segment. I think over the last decade, all the Zerodhas and Grows of the world have played a big role in deepening equity markets in the country. And we believe as Jiraaf, we'll play a leading role in deepening the debt market or bond market here, in India. So that's our effort. So what do we do as Jiraaf? So we are a very simple platform. You will see a lot of curated risk assessed deals on our platform if you log in, for example, right now. What does this mean? Basically, these are counterparties, companies whom we have, done the due diligence for. We do the filtration, credit assessment, due diligence, whatever you call it. We look at these companies. We take a view that these are good quality companies, and the money for the horizon of our investment or for the bond horizon, our money is likely to be safe, and this company has enough capability to repay the investment amount or the money they are raising through the issuance of bonds, right? So this is the analysis or this is the filtration that we have done. Once we have built this comfort, these get listed on our platform, and as individual investors, you can access and invest on our platform through a click of a button, right? So it is making earlier discovery of bonds, finding out which bond to buy, which is a good bond, which is a bad bond, whether which is the right tenure. A lot of this we have, I would say, looked at a wide universe of bonds that are available, and we believe that these are the some of the good quality bonds that you should look at and invest in. So we've done the filtration. We are giving you a select 4 5 6 bonds that you can look at. And if you feel that this you are able to understand what the product is, what the company is, what the risks are, it is your choice to invest. But once you choose to invest, you can do this at the click of a button. So it's a very easy to use technology platform. Within a couple of minutes, you can actually make an investment and then also start tracking your investments and tracking your overall portfolio. Over a period of time, you'll realize that if you made 5 6 investments, you have actually created a very robust fixed income portfolio on Giraffe, right? So that's what we are trying to do. Some of the products that we offer, they have their own nuances of security, tenure, and yields. But we offer short-term treasury bills, which is less than 1 year. Listed corporate bonds. These will typically be between 1 to 3 years, which is the horizon which we like. These corporate bonds are secured. They are senior secured bonds. They will be secured against collateral provided by the companies. These collaterals may be underlying receivables. It might be hard collaterals. In some cases, we get personal guarantees, corporate guarantees, etc. So these will be rated papers. So you can also see the rating by an external rating agency. This is only an input in our rating process, in our credit assessment process, but it will still give you some level of standardization that a rating agency has given for this paper. Third is again government securities and state development loans. So government securities basically when the central government is borrowing. State development loans is when the state governments borrow through issuance of bonds. These are typically starting from 5 years to very long tenure. But we also bring these bonds from the secondary market. So we do the sourcing from the secondary market, and in a lot of cases you will be able to invest in tenures which are much lesser than 5 years. right? So which is again the curation and filtration that we do, picking and choosing, because if there's a 3-year horizon, then a government or a state development loan is quite attractive. We don't want to lock our money in for 10 years, 15 years. Last is securitized debt instruments. This product gives us a lot of flexibility to innovate, and you will see a lot of this coming up on our platform in the future. So we will be able to create different pools and baskets of fixed income products or loans, and you have the ability to invest in a well diversified fixed income portfolio, but in one investment. So your risk is diversified that much more. So again, instead of giving it to one counterparty, you can think about your money has gone to 5 counterparties, and because that is now a wider diversified pool, my money is safer. So that's why these SDIs give us a lot of scope for innovating, and we'll bring new and quite, I would say, never seen before products through this instrument in the future. The next is, as Jiraaf, again, we have a very robust credit assessment process. Typically less than 10% of the companies that we meet, we are able to actually, filter and bring them onto our platform. So right from, I would say, information to the opportunity getting listed, this is almost a 2.5 month process. We have a large investment team and a credit and risk team that handholds this entire process. We also have our own investment committee which decides which opportunity should be listed or not. So it's a very thorough, detailed process which takes 2.5 months for every counterparty, and we're able to work with less than 10% of the companies that we meet. Be rest assured that when these opportunities are listed on Giraffe, these are highly curated, filtered, and we have the belief that this company has the ability to repay. So you can complete your KYC, look at all the listed opportunities on a platform, complete your payment, and get the securities in your demat. All of these securities you will get in your demat account that you provide. All the repayment of these securities will come to your demat linked bank account, right? So this is a very simple 3-step process. So I would request, everyone should try out the platform. Only when you try with the minimum sum, you can try with even 1,000 rupee, 10,000 rupee investment. That'll give you a hang of the platform, and then you can go about building your fixed income portfolio. So thank you, everyone. So that brings us to the close of the presentation.
So
Great.
thank you everyone. Thank you for taking out time for us and participating in this webinar. We look forward to hearing more from you. Please feel free to reach out to us in case you have any more queries. We'll be happy to address those queries and answer it for you. Thank you again.